Hello everyone, this is Dr. Zaidi. Welcome to my YouTube channel ZTube. In this video, I'm going to provide you a brief overview of master budgeting. So before we start master budgeting, let's discuss what is budget. Budget is a plan, a quantitative plan that tells you how are you going to acquire resources and how are you going to use those resources in a certain period of time, right? So for example, a budget can be prepared for a yearly basis, monthly basis, quarterly basis, weekly basis, even daily basis. So how are you going to acquire the resources, the money, the material, the labor, and other available resources, even the faculty, the facility equipment, the machines, land, building, and how are you going to use them in a specified period of time to generate the profitability for the company. So basically, budgets are used for two purposes. What are those purposes? The planning and controlling. Now, whether you are the accounting major, you're a business major, or you are a non-business major, non-accounting major, and you have no idea what planning and controlling is, everyone does it in their daily life. I'll give you a general example of planning and controlling from your daily life. Let's say that you decide to go to your work and you decide to take a freeway and you decide to leave for your work at 7 o'clock to be there at 8 o'clock. Now, your plan was that if you leave home at 7 o'clock, you're going to be there. If you take a certain freeway, you're going to be at your work at 8 o'clock. Now, what happens is that when you enter on the freeway, you found that there is an accident on the freeway. Now the traffic is jammed. Now you have two options. Either you just stay there and get to work late, or you exit and take a local road and then drive to your work, and you may be able to make it on time. So the planning phase was what that you decided you go to work and you leave your home at around 7 o'clock so you can be there at 8 o'clock, right? The controlling phase is that when you are already on freeway, you found out that now this is not going to work. Either I'm going to be late at work or I have to change the directions I'm going through. So then what you do is you decide, you make decision. Your decision is whether you're going to stay there, and wait until the traffic is clear, or you're going to exit and take the local road. So this is a general example. Same thing with the companies. When the companies perform planning and control, they plan that how much sales they are going to make in the current year, or how many units they have to produce in a current year, or how many labor hours they have to work, or how much labor cost they're going to incur, or overhead. So they create budgets for everything. So they plan that they have to make, let's say, that $100,000 sales in 1 year. Now, to achieve $100,000 sales, they make quarterly goals, they make monthly goals, they make weekly quotas, they make daily quotas. And so if, let's say, for 6 months now, if they develop this in half yearly, then if they want to make $100,000 in a year, then they have to make $50,000 sales in 6 months and $25,000 sales in a quarter. So if they are evaluating and then the first quarter cross and they didn't make $25,000, let's say that they only made $15,000 sales. Now they have to decide what they want to do. Either they can reduce their budget for the next upcoming 3 quarters, by 10,000 each. So making a total sales of 60,000 for the whole year. If they think that the economy is slowing down and they can only make up to $15,000 in each quarter, then they can do that. Or if they think that, for certain reasons they didn't make it, or didn't put enough efforts to make the sales, or the sales was only down for this quarter and it's going to go up. So what they can do is they can revise the plan, and they can say that, okay, in the next 3 quarters that we have left, now we have to make $85,000 sales. So they can split it up. So instead of $25,000 per quarter, now because they were $10,000 short, so they can split 3,333 each to the remaining 3 quarters. So thereby increasing the sales to $28,333 per quarter. So they can revise the plan, right? And if they think that, no, this is not an okay plan to allocate the lost sales evenly to the 3 quarters, what they can do, they can, okay, what we can do is in the December is going to be a busy season and it's going to be a Christmas, we can make more sales towards the end. So let's plan for achieving 25,000 target in the next 2 quarters each. And then in during the Christmas, we can make $35,000 sale, and we can end the year with $100,000 sale. So the purpose of saying that is that you can revise, right? If you have not achieved your target, if you have developed a shorter budgets or smaller budgets, instead of waiting until the end of December and finding out that, oh, you are like $40,000 short or $30,000 short. If you find out early, you can revise your plan, and then you can work on achieving them. On the other hand, there is a possibility that there was a budgeting problem, and the managers who perform budgeting didn't have any benchmark, and the idea from developing a budget, or idea of the companies that have benchmarked before. So there is nothing available for this person, either because the company is new, a product that you are producing is new, or because there is lack of experience. So in that case, then the manager decides that, or the top management decides that, what they have to do, how are they going to revise the plan, are they going to achieve the remaining targets, the $85,000 that was supposed to be earned in the next 3 quarters, or are they going to revise the whole budget and they say that, okay, we cannot make $100,000 just because the person lacked the experience, the person didn't have the knowledge that we are going to make $25,000 each quarter, so that's probably a poor budgeting. So let's just reduce the budget and we go from there. Or if the market has slowed down, there is nothing you can do, the product demand has gone down, and there is no expectation that the product demand will go up in future. In that case also, you can reduce the budget. Okay, so purpose of budgeting. The purpose of budgeting is that it forces managers to plan. Basically, if you know that you're preparing budget for future, you're planning for future. How are you going to achieve certain targets, right? It provides information for the decision making. So, for example, if you haven't, the example I gave you for freeway, if you are not going on track, so the controlling part is that you can revise your budget, right? So it gives you an opportunity to make decision. Or if in the last year you didn't do well, you didn't perform budgeting well, then in this period you can perform better budgeting by revising or avoiding the mistakes that you have made in the prior period. It also provides benchmark to evaluate the manager's performance. If you see that the managers are not achieving quotas or goals, so for example, the sales department has to achieve $100,000 sale every year, and you see that they are failing to achieve that goal, then you don't have to provide them let's say the bonuses or stock options that you are providing them. And if the department is achieving those goals, then you can offer the benefits to the departments. Can provide bonuses, and you can provide stock options and increase in salaries or promotion, whatever you want to, or your company wants to provide. So it gives you benchmark to evaluate their performances. Your goal is to reduce the cost, then you can judge the department by whether they have reduced the cost or not, whether they reduce the material cost, if it's a purchasing department, if it's a wages payable department, or the labor department, then you can see that if they have reduced the cost of the labor hiring or not. It also improves communication and coordination between and among the departments. So if the sales department knows that how much the sales is going to be in future, they can contribute that knowledge to the production department and tell them that, okay, we expect that we're going to sell 50,000 units, so you have to produce 50,000 units. When production knows that, then they can hire labor accordingly, so they can contact with the HR department. They can also purchase material accordingly, so they can reach the purchasing department and say that we need this much material to produce 50,000 units. Can you provide us? Right? So it improves basically communication and coordination between and among departments. Okay, so then, whether the budget is successful or unsuccessful, it depends on how it is developed. Sometimes the top-down approach can be successful. On the other time, self-imposed or participative budgets can be, beneficial. So both have their own advantages or disadvantages. In a top-down approach, the top management imposed the budget. They said that this is what we are expecting, that you have to achieve this. So the top manager says that this is our sales quota, we are going to target this kind of market, and you have to make this much sales and make this budget possible, right? And the line managers take that and then they try to implement that. Now the disadvantages of this is that okay, line managers may have a more knowledge than the top management of their department, right? So if the CEO is imposing budget on a production department, manufacturing department or purchasing department or assembly department, then they don't have as much knowledge of the purchasing department, how it works, what kind of costs involved. Same thing with the manufacturing department, assembly department, and other department. Then the person who are the in charge of that particular department, they have the first-hand knowledge about that department. So in those cases, that can be dysfunctional, especially if the companies are large enough and they're producing multiple products and they have various departments. This can be dysfunctional. It may work in a small company where you have only 5 employees working. It's probably a CPA firm or a tax firm or a small law firm. It may work on something like that because the owner of the company is in charge and they know how the things work. But other than that, in bigger companies, it becomes pretty much dysfunctional. um, and So the other option we have is a self-imposed or participative budget. In the self-imposed participative budget, the line managers participate in budget making process. So the example is that, okay, the purchasing manager has a more knowledge that where to purchase raw material and what kind of raw material we have to purchase. Because if the top management pushes purchasing department that you need to reduce a cost for raw material, then they end up buying poor quality material for low cost, and that can hurt the quality of the product. That can increase the cost of the production department because the cheap raw material keep on breaking. That can also affect the cost of the quality control, because quality control keeps sending back those products to rework on. It can increase the cost of warranty claims and expenses. So, and you will eventually lose customers who are not happy with your product and the quality of the product. So it has a long-term impact if the top management imposes the budget and without asking the line manager. So the line managers have their own, and they have the knowledge of their own department, how it works and what kind of quality they have to maintain and what kind of cost structure you have to maintain. If you end up hiring a cheap labor, or which are inefficient or untrained workers, then yes, you may hire a cheap labor, but then they won't be able to provide the quality of the service that they should, right? If they are inefficient, they will take more time to make the product, or if they are untrained, they keep on breaking materials, which will increase your material cost as well, even though if it's a quality material. So eventually you are end up losing more money if you impose the budget. So in those cases, in a big companies like that you need to find the people who are in charge of their particular department, whether it's managers, supervisors, or production manager or assembly line manager, and then ask them. uh, if you do that, then what happens is that they feel that their judgments are valued by the top management, and they will be like more motivated to work hard and then more motivated to provide better results, right? And their estimates are going to be more accurate, and they will be able to produce a reliable budget compared to if it is forced by the top management. The other thing is that if they have variance, which variance is the difference between the actual results and the budgeted results, right? So if they have budgeted that, oh, I'm going to incur only $50,000 cost, and the cost came out $60,000, now they don't have excuse, because you developed the budget. Now, how come it went up by $10,000, right? So they should have a good answer for why the budget went up. Oh, the material price went up, because of the shortage of the material, or the labor cost went up because of the shortage of the labor, right? Or because we, needed a quality, workforce, or because the material, because there was a high demand of our product, so we need to rush order material, which has increased transportation costs. So that's why our costs, went up. So they need to have a really good excuse in case of variance. Otherwise, they won't be able to justify it, and they're going to be in trouble. So these are the advantages of the self-imposed or participative budget. However, there are limitations too. Limitations are what? Limitations are the budgetary slack. What is budgetary slack? Underestimating revenues and overestimating costs. So how do you underestimate revenue? So if the sales manager knows that they can make $100,000 sales a year, what they can do is they can, say that, oh, I estimate that next year sale is going to be $90,000. Okay. So the top management took it, $90,000, although the manager knew that they can make $100,000 sale. So at the end of the year, they made $95,000 sale. Now the top management is happy because the top management received the budgeting at $90,000, and they were like, oh, the department made $5,000 more sales from 90 to 95,000. They didn't know that, oh, they were supposed to make $100,000 sales because the sales manager knew that they can make, but they didn't make it. So they were actually $5,000 short. But because the top management wouldn't know, they would give them bonuses for $95,000 sales because they exceeded the expectation. So that's budgetary slack. This is like underestimating revenues. They underestimated revenues. Similarly, overestimating costs. The purchasing department say that, oh, I'm expecting the cost is going to be $50,000 for that many units that we are going to produce next year, right? Although the production manager or the purchasing manager knew that they can purchase raw material for $45,000, good quality material. Now they overestimated the cost, that, oh, $50,000. Now at the end of the year, they incurred $48,000. Now the top management is happy. Oh, you saved us $2,000 because you said $50,000 is going to be the cost. And they give them bonuses. But actually, they incurred more than they were supposed to, because the purchasing manager knew that they can purchase the material for 45,000, and they gave the wrong number at 50,000. And now they incurred 3,000 more, and they get $48,000. And incurred $48,000, but it still get bonuses. Why? Because they overestimated their budgets, right? So that's budgetary slack. So they built slack in their budget, right? So that's a limitation of the self-imposed or participative budget. The other is that suboptimal performance. Suboptimal performance is when they know that they can achieve the target easily. They're not going to push as much effort as supposed to be. So the sales, if they knew that the sales, they can easily achieve $100,000 sales, but they provided you 90,000. So they are not going to put effort to reach $100,000. They're like, okay, we're going to put as much effort as we can get 90,000. And if we go above and beyond, then it just, it's great. If not, then we actually achieve the target. So they're not going to put more efforts to achieve $100,000 target. So, so that's a suboptimal performance, when they don't perform optimally. So the master budgets are prepared yearly, right? They can also be prepared quarterly and monthly basis. So when company prepares yearly budget, they don't wait until the end of the year or December to see if they are on track on their budget or not. That's where a controlling part comes into play. Is they prepare a quarterly, monthly budget. Even some companies build weekly budgets too, to see that they can stay on track. And you can also do daily budget, so you can know that you're staying on track daily, so you don't fall short. Okay, there are two kind of budgets: zero-based budget and continuous budget. So zero-based budget is that it starts from scratch. So every year, right, once you reach December, right, you have a brand new budget for the next year that goes from January through December. So for example, this is what this is. If assume that this is um, the end of January, right? So now you have 11 months left. Okay, so now you have 11 months left. That's you have 11-month budget in your hand. Once February passes, then you have 10 months left. Once March passes, then you have 9 months budget left. So until you reach when you reach December, you have 0 months left. Then you start brand new budget from scratch that goes from January through December. Whereas in a continuous budget, which is also known as perpetual or rolling budget, is a 12-month budget that continuously rolls. It rolls forward. So once you reach at the end of January, right? So if it's 2000, let's say that today is January 2020, right? End of January 2020. So when you reach end of January 2020, then you're going to add another month towards the end, which would be January 2021. Okay. Then you passed another month, February 2020. Then you add another month towards the end. Okay. This is now February 2021 is added to the month. Then you reach March 2020. Then you add another month towards the end, which is March 2021. So at any given point in time, you have the whole year budget in your hand. Unlike the zero-based budget, when you pass 1 month, you have only 11 months left. When you pass 2 months, you have 10 months left. No, in a continuous budget, you're always going to have a 12-month budget left. So you can do a rollover budget on a monthly basis when you can add month at the end of every month, or you can do based on quarter. So you once the first quarter ends, then you can add the whole new quarter towards the end. Then once the second quarter ends, then you add the whole new second quarter towards the end. So that's your continuous or perpetual budget. Now we move on to the how the master budget looks like. So this diagram represents how our master budget looks like, right? So the business exists for what? Business exists to make money, right? So our first budget is a sales budget. Everything starts from sales. If we make sales, that's when we are going to have other budgets. Okay, so this is a budget for a manufacturing facility, because manufacturing companies have the most complex cost system. Service industries don't have material labor, and they just have overhead, but not manufacturing overhead, just overhead. They don't have direct material. They don't have manufacturing costs. They also have a direct labor, but they don't have a manufacturing cost. Same as merchandising company. They don't have a manufacturing cost, but they have labor and overhead. So that makes the manufacturing companies most complicated in terms of budgeting. So we start with sales budget, and sales budget determines your production budget. So once you know that how many units you're going to sell in the next month or the next quarter or the next year, you can work on production, right? Your production depends on how many units you're going to sell. Okay. And then your production relies on material, labor, and overhead. So you prepare direct material budget, direct labor budget, and manufacturing overhead budgets, right? Now your production budget also leads to the ending finished goods inventory budget. If you have if you can bring something from the beginning inventory or last period's ending inventory, or you can sell some units, which becomes cost of goods sold, and you leave with the ending inventory, the units you are unable to sell. And then cost of goods sold leads to your income statement. Okay. Again, the production budget, which is material, labor, and overhead, leads to your cash budget, right? Cash budget also tied up with the operating expenses budget, which is tied up with the sales budget. So, for example, sales commission ties to the operating budget. Operating expenses budget is the selling and administrative expenses budget, research and development budget. Okay, ties to cash, the amount of money you're paying for operating expenses. And then income statement also, if you're making the sales that based on cash. And the sales budget also ties up with the cash, for the cash that you are paying. You're making sales cash. And sales budget also ties up with the capital expenditure. If your demand goes up, then you may have to buy more equipment, machines, rent or lease a facility, stuff like that. So that also ties up to cash and also ties up to balance sheet, because that's an assets. Cash ties up to balance sheet, income statement ties up to balance sheet, and then balance sheet goes to cash flow. So they are somehow related to each other. One leads to the other, and the other leads to the next one. Okay, so that's our master budget. Some companies prepare a lot less, or in a condensed form. Some companies even prefer in expanded form. So for example, operating expenses can be budget can be prepared separately for selling expenses, separately for administrative expenses, and separately for research and development expenses. So it depends on companies to companies. And also the links can be, most likely the links looks like this, but sometimes based on the company's requirement, if they don't make any cash sales, then they can avoid that link from sales to cash. So it depends on what kind of company you're dealing with. Okay, that completes your master budgeting, a brief overview. Thank you for watching my video. Please subscribe my channel for live updates.